Hey everyone, welcome to Coach's Playbook for this week. What is the date today? What week are we in? It's the end of January, I believe.
January's coming to close. It is leap year, so January is a little bit longer. But I think it is still January.
Are you sure? January is longer?
February, excuse me. Gosh,
it's got a long week already.
I'm fried. I'm fried.
Today, we want to talk to you about some high probability trade setups that we've used along the lines in our careers. I think this is good. Honestly, nothing's 100%, but these are things that we found along the way that give a pretty high chance of working out, which is what we're all looking for.
Even more important to me than that is the reward over risk that some of them can provide.
Ooh, that's
Could not agree more. I think that's kind of. I got a feeling most of you guys are going to know what John and I are going to talk about. You hear us talking about a lot of these a lot of the times.
Yes.
But you start to learn the trade setups that work for you because you've learned that the risk is cheap in them. If you can find trades that allow for cheap risk, you're going to want to take that trade over and over again. And over time, you start to get better on those entry points. You get a little bit better on knowing when to look for those trades. Mm-hmm. And over time, you start to realize how little you can risk to be profitable in those trades.
Hey there, Jay and Murat and Brendan. And by the way, in case you see me sipping this from time to time, this is actually soda water and mint. I'm not drinking a mojito.
Right.
On a Wednesday. Yeah, it's just...
You cannot drink all day unless you start in the morning.
I feel lonely. I've got no drink with me.
That's cool.
This is coffee.
Coffee, water, mint leaves. I'll mention that a few times.
Maybe a little Is it Irish coffee?
This is some serious gourmet stuff right here.
Nice. So with that out of the way, who wants to kick things off?
Well, first, I've got a couple funded traders to give a quick little shout out to that have been taking out some really great withdrawals this week. I only just wrote down 3 of them. Muhammad taking out $5,000, and just to note, Muhammad started in his funded account last week. Made $9,000 last week, is currently up right now in an active position over $1,800, and has withdrawn $5,000 already. So
nice.
Really off to a strong start in that account. So Muhammad, keep it up there. Tudor, $4,500. Just withdrew that yesterday, and then Fatima taking out $3,000. So some really, really big withdrawals, and taking advantage of these really great markets that are proving fruitful. Right now.
Out of curiosity, do you know what Muhammad was trading?
Muhammad's just been strictly trading crude oil.
That's a good one to trade.
Right now, it is an actionable market. He's traded small. He's leveraged into some of his trades, not short or long, but both. So he's comfortable going both ways, and it's proving beneficial for him. I've been on the phone with him quite a bit over the last couple days.
Nice job to the 3 of them.
Absolutely, really exciting stuff.
Mm-hmm.
Well, that's great. Well, now that we've given them their kudos, what do you say we talk about some setups or some
I think we could do that.
high probability trades?
Sure. Dan, why don't you go ahead?
All right, it should come to you guys as no surprise. If you've seen me on anything we ever do, I talk about settlement price. The reason settlement price is important to me, it was the first trade ever taught to me when I first started understanding what trading was. And it's not one specific thing, but more or less how markets look to go towards settlement price and how markets react at settlement price. So a lot of times a market will be open up away from settlement price, or be trading away from settlement price. The first thing I'm doing every single time is saying, okay, how and what is going to get this market to return to settlement price? Where's a point that maybe if it's trading below settlement price, where's that point I can find some support to enter into the trade and look for my profit target to be at settlement price? On the flip side, settlement is a great accelerator or springboard for a trade. A lot of times you will see, and I think I've seen it in S&Ps today, it sprung through settlement price, returned back to settlement price, and then took back off once again. It creates great opportunities. Now, what it's going to do when it gets to settlement price, that's always a tough question. You have to do a little bit more research. Understand what the price action at that settlement price has been recently. How has the market continued to react around that? Is this a trend market? Are we ranging? What's the news? What's the catalyst that's going to get this thing to move to help kind of make that determination whether you want to use it as support or resistance, or you're looking for it to be that springboard, or you're looking for market to just start to accelerate as soon as it hits that price. So there's a lot of things that can happen. But more or less, I'm looking for 2 things. I'm looking for a trade off of settlement price, and I'm looking for a trade going back to settlement price. It always was told to me, I used to ask the question, why is settlement so important? And I've never gotten an honest to God true answer behind
They
it.
said because it is.
That was it. It was because it is. Think of it as a magnet. And if you go back in time, you can look at a lot of these markets, they look towards settlement all the
Yeah.
time.
Hey there, Ivan, and may I give my hypothesis on that?
Absolutely.
Numbers like those only matter because people think they matter. It's the same thing with, you'll see prices that are big round numbers. Why does that have to do with anything?
Right.
You know? But if enough people are thinking that that's an important point, that they're going to see it as a point where it's going to extend or retrace,
Right.
then it's a self-fulfilling prophecy, and that's why it's important. I think that's the case with settlements.
Absolutely. And I also think about it in the sense of people, the bigger institutions, they run their positions based off of settlement price. At the end of the day, they are running P&L for their open positions based off of prior days settle. So they are looking for that market to return to that. Maybe they are down some money. If we start to return to settlement price, that will start to help things out for them.
Yeah, once again, that's not something that should affect your mind, but I remember when I was at the shop, if you got, good settles the day before, you look at your P&L the next day, and it's pretty red, so you're in that fight to get back to zero. I mean, doesn't make any sense. You should just be trying to trade your best based on the situation, adjust things accordingly, but, that big red number, big round numbers, big red numbers, they tend to mess with your mind a little bit.
That they do.
All right, I think it's now my turn, and if you've seen me at all on the forecast or the recap, one of the first things I look at on any given day, and my coaching family members are going to be very familiar with this, is the opening range. The opening range is the first minute of the regular trading hours. In crude oil, it's from 8 o'clock till 8:01. S&P's 8:30 to 8:31. That first minute has a tendency, particularly in directional trade, to remain the extreme on one side or the other of the daily range. If you look at the crude oil this morning, I don't think it was the crude oil yesterday and the S&Ps yesterday, that first minute of trade ended up being one of the extremes of the session. And knowing that and keeping track of how often it occurs can give you a decent opportunity early in the session, especially if price opens outside of the previous day's range. I think there's more of a tendency for the opening range trade to provide opportunity for you. So the way I'll look at it is I'll watch that first minute of trade. As soon as price exits that first minute range, I'll go with that direction and put my stop just a few ticks the other side of the opening range. When you look at the opening ranges, whether you're looking on a market profile or in a 1 minute chart, you're going to notice that that first minute is generally going to be kind of a small range. So that first opportunity that may end up being the extreme for the session in one direction or the other offers a cheap opportunity. Sometimes you're going to get some bigger opening ranges. Those might be a little bit more difficult for you to take because there will be expanded risk on those. But generally speaking, in the S&Ps, you're looking at 2 to 3 points of risk if you take the opening range trade. You're looking at crude oil, you may be looking at 10, 15, maybe 20 ticks of risk. But if the market does maintain directional activity away from that opening range for the entire day, you have no idea how much profit you can take on those opening range trades. Now, another thing to think about is we're not the only ones looking at these opening range trades. Quite often, if you see the opening range trade happening day after day or with relative consistency, your competitors are also noticing, hey, the opening range trade is working, and the more people that get into it, the less likely it's going to provide that opportunity for you. So keep your eyes, keep track of how often the opening range trade is happening. If it starts to kind of fall off, it's not. I hate to use the word working. If it's not providing that same opportunity, watch. The short time frame traders that are piling in on it are the first to abandon it when they perceive it as no longer working. It's no longer working, we're going to get rid of it. Then it's kind of cyclical. You'll see it start to appear more often and provide opportunities, and as soon as everybody notices and piles in, you back off of it a little bit, And then you'll see they'll all bail out of it, and then you can start to take another look at it. The great thing about it is it's usually very low risk, early trade. You don't have to risk a lot. If it doesn't play out, you're still in business looking for the next
You
opportunity.
still got a heck of a long day ahead of you to keep
Yes.
trading.
Real quick question, John, from Darnell. Says, thanks for the explanation. What about a wild open with 35 cents in 1 minute in crude? Do you have a point of pain where you say, no thanks?
Yeah, of course. I'm not going to be risking 40 ticks of risk on anything in crude oil as a day trader. I think that's a little bit outrageous. If you do have a big opening range like that, kind of similar to the opening range, I think it's today. I think it was a 22 tick opening range, and if that's too rich for you, you sometimes will get the opportunity to see price go back inside that opening range. If you can get in maybe halfway through that opening range, that's going to minimize your risk on that. And if the opening range trade does continue to play out, you're in great trade location for possible, I've seen opening range trades pay 10, 15, 20 times the risk on some days.
Yeah, absolutely. I think it's all about a matter of understanding what your risk you can take. Obviously, every market's going to open up a little bit different. Some days are going to be more volatile than others. If you can handle the risk, that's 100% on you. That the setup is all within that first minute and how it reacts.
Sounds good. Thanks, John.
Yeah.
All right. May I have permission to bore the hell out of everyone?
Grab a pillow.
Well, that's right. I got coffee. I'll be awake.
Grab a pillow, take your trucker pills, everyone, buckle down. Most of our traders are concentrated in equities and crude oil. Would that be a fair assessment?
Yes.
At the top step, at least.
Yes.
Okay. I come from the world of bonds, specifically treasury bonds.
Mm-hmm.
So here's the setup that I'm going to offer for what some consider a less sexy instrument. And it only comes ever so often. It comes when the yield are making fresh lows that they haven't seen in close to where we are now in a decade, or when they're making fresh highs for the first time in a long time. Today I want to talk to you guys about a little phenomenon called mortgage convexity hedging. What that is, okay, don't fall asleep, guys. Guys, you're going to like this because it's a great trade.
Can you say that again?
Mortgage convexity hedging. What
Jack
that
went
means-
undergrad at Northwestern, got a master's from Notre Dame. He's very educated.
What this means is, bear with me, there is a payoff here. What it means is that a large portion of the world's fixed income portfolio, when you talk about pensions, insurance, everything like that, they are the buyers of your mortgage, the pools of mortgage, everything else. You can look this up if you want more info, but most bonds have positive convexity. Mortgages have negative because they are very sensitive. When interest rates go down, people refinance and it changes the duration of portfolio. What that means is they have to keep that duration there, so they hedge it by making huge purchases or sales in the treasury market. What that means is when you hit new lows, all right, or new highs, as it pushes through those, there's going to be tons of pushing it in the same direction by massive money funds, insurance, pensions. I saw somewhere in March, it's somewhere along the lines of more than $90 million a basis point. So if we get to a point where you see new lows or fresh highs, if you see those order flows coming, chances are it's going to accelerate. And that is an incredibly awesome trade. Even if you're not necessarily the biggest bond person, if we ever reach to the point where you're seeing fresh yield lows, or if we finally start raising again, keep an eye on stuff like that, because it's a phenomenon. This is a basic overview, read more about it, and hey, maybe you'll become a bond person like me. Probably not, as you noticed, kind of bored.
Slow and steady.
This is fantastic, though. That's really
It's an interesting concept.
Really good information.
Yeah, it gets more to the macro stuff.
Sure.
So that's my petty thing that I offer today.
Awesome.
Outstanding. Also, real quick, I know, Sarah, you made a comment here just asking about what settlement is. Settlement is basically, essentially, there's a calculation to it, but it is essentially the last price traded on that pit close. You can find this pretty much every single platform. If you open up your quote board, it's either in there or it's an option that you can add to it. Some platforms even let you add it into your charts as like an indicator, so to speak. And then obviously the CME website always is posting settlement prices for all contracts at the end of each and every day. And then also about the sound, everybody. Those of you that normally listen to this, is it different than normal? I do apologize if we're having issues. Everything seems to be streaming okay on our end. So those of you that watch regularly, let me know if it sounds different so I can take a look at that afterwards and get that fixed for us.
Yeah, thank you. Thank you for letting us know.
Absolutely.
Yeah, thank you for enduring my macro minute, as they say there. Yeah, just look up that sort of stuff. It's, you know, if you want to learn more about the economy, it's a fun way to do it. I guess it's not fun.
Well, it's markets, and to me, you know, anything I can learn more and more about the markets just seems to help me in the long run. So it's important stuff.
Absolutely. And Alan, thank you for letting me know. And then Caesar, you're welcome for all the golden nuggets. Let's hopefully we can keep providing more and more.
Yeah, it's Wednesday. We got a little bit more today. 2 more days. Close out January on a strong note, everyone.
Yeah.
Absolutely.
And see what the FOMC does.
Tomorrow's my final day. I will be gone on Friday.
Mm,
Outstanding.
nice.
Yeah.
Well, maybe I'll come in and sub for you. We'll see.
Oh, there you
There you
go.
go. We'll have Jack hop on the recap for me.
Awesome.
All right, awesome. So do you have a quote for us to sum this up?
I do. So John made a really, really interesting point when he was talking about that trade. It's not going to work every single time. There are times where it's going to kind of not work. It's kind of cyclical. So I have this quote from Steve Jobs that I thought really stuck out to me. And focus does not mean saying yes. It also means saying no. Recognizing, hey, when these things aren't working, let's step back, wait for things to start to fall back into place. So that comes from Steve Jobs, and pretty interesting guy. Recommend learning a little bit about him.
Yeah, he was pretty successful.
Yeah, he did. I think the company that he's started is like the biggest company in the entire world according to their market value.
I think I hear my ride.
Oh yeah, the ambulance.
Yeah.
Something Steve Jobs doesn't believe in.
Oh.
Yeah, I guess it's not too soon. Anyway, guys, thanks for stopping by for this episode of Coach's Playbook. We'll be back next week. In the meantime, have a great backside of the week, and we'll see you then. John?
Yep. Get out there and profit. Trade well.
Trade well, everybody.